Greetings, everyone. I'm David Darst here to recap November. And as we start doing so, I want to take you back to July 26th, which is when the Fed, that was the last time they raised interest rates. And ever since that time, we had a couple of conflicting moves. First is in the month of August, September, and October, the stock market, the liquid stock market in the U.S., went down each of those months, 2%, 5%, 2%, okay, just like that, before rallying here in the month of November by almost 9%. NASDAQ up 11%. This is as of late November. And the bank stocks up 13%. Interest rates going up and then going down, and the stock market going down and then going up. The stock market going down and interest rates going up for several reasons. Number one, this huge amount of treasury bonds, notes, and bills being issued by the United States government. So big supply of bonds. Secondly, the demand for bonds slowing from China, slowing from Japan, which has begun to let interest rates rise gradually there. So people feeling that their appetite for treasury bonds would be diminished. You also had a lot of talk about government shutdown, as you know. You had a lot of talk about the debt outlook by Moody's and by Fitch, two of the three big rating agencies. The third one, of course, is Standard & Poor's. These rating agencies have all put the United States on negative outlook. They have not yet downgraded, but they put them on negative outlook. So these factors, huge treasury supply, questions about the dysfunctional aspects of the politics and government, that led to interest rates going up, even though the Fed stopped raising interest rates on July 26th. This thing turned around in the beginning of this month, in the beginning of November. Why? Investors began to come to the conclusion that the Federal Reserve was basically done with raising interest rates. As of late November, the Fed Fund futures market was assigning about a 30% chance of the Fed cutting interest rates on the March meeting of the Federal Open Market Committee, March of 2024, and a 58% Fed funds futures probability, and these fluctuate all over the place, and the May meeting. So investors began to get around to the conclusion that the Fed is not going to be raising rates, and they start thinking about when are they going to cut interest rates. The Fed Open Market Committee minutes of October 31st, November 1st. So the minutes from that meeting were released recently, and they said there's only one criterion that would cause them to actually turn around and begin tightening again. And that would be if progress towards reducing the inflation rate to 2% is insufficient. The word insufficient was focused on by many financial market participants. You've seen a moderate slowing in the economy. You've had companies like Walmart, like Best Buy, the Saks Fifth Avenue, okay? You've had these retailers basically issuing a kind of a cautious commentary and lowering guidance. So that basically was indicating to us that recession forces are there. Now, the recession forces, and we're focusing on this, we may be wrong, but we've noticed often when we have this call for a soft landing or no landing, they had that same thing in 2000 and the same thing in 2007 before you actually had the recession hit. Why do we think there's the risk of a recession? You basically have the inverted yield curve. That started to get inverted July of 2022. Secondly, you have the lead economic indicators have been down for 19 consecutive months. You have China slowing, okay? General cautious tone that I just mentioned by the corporate chief executive officer, chief financial officer. As I mentioned a moment ago, the dollar has had one of its weakest months. November has been a very weak month as interest rates have begun to soften a little bit. The 1-year inflation expectations of the University of Michigan consumer sentiment, we follow that very closely. The 1 year ahead actually went up from 4.2% in September to 4.5% in October. These were released here at the end of the month of November. And the 5-year was actually went up also from 3% expected inflation up to 3.2% expected inflation. So our stance continues to be that the 60-40 model, 60% stocks, 40% bonds, needs to be adjusted. It needs to be modernized, where you have an allocation to alternative investments. And here we're talking about private real estate. There you want to basically focus on being a lender to good operators and good properties to fill in the gap, the financing gap in the capital stack to get well compensated. We think alternatives deserve a place, as you know, because of their risk reduction, yield enhancement, and volatility reduction. This is, now again, you have to focus on getting good managers. The second is private equity. We like private equity. Valuations have come down. And within private equity, we see these secondary market transactions where people sell existing partnership interests. And we've found the ability to find managers who are able to pick up these partnership interests at very, very attractive rates of return. Private credit is the final part of the alternative spectrum that we've basically been looking at. And private credit, basically, you have generous yields there as long as you're basically in the right, with the right borrowers and with the right asset managers in this private credit space. With that, we want to thank you for being with us, and we wish you a tremendous start to the month of December, and we look forward to catching up with you very soon.